Friend, have you had a strong feeling lately? Is something really wrong with the financial markets? Over the past few weeks, it seems as if an invisible hand has slammed global markets into shock mode. Gold prices have skyrocketed, surpassing all-time highs of over $3,500. Silver, not to be outdone, surged past $40, reaching a 10-year high. Suddenly, long lines formed at domestic gold shops. Gold ETFs saw a single-day net inflow of over $5 billion, and silver ETFs saw their largest inflow in nearly 8 years. Many people's first reaction was, has the Russia-Ukraine conflict escalated again? Has fighting broken out in the Middle East again? Or has something major happened in the Taiwan Strait? None of these. This epic rally in gold and silver wasn't triggered by a geopolitical crisis, but by a silent earthquake in the global bond market. Doesn't that sound counterintuitive? How could bond market volatility cause gold and silver to soar? Don't worry, today I'll reveal the shocking truth behind this volatility. I bet most people still don't fully understand what's happening. Let's quickly review what actually happened. This past August was dubbed Black August in the bond market by Wall Street. Government bonds around the world are being sold off frantically, causing yields to soar. But what are the root causes of this phenomenon? What chain reactions will this trigger globally? Today, we'll take a closer look at this bond market earthquake and thoroughly explain it. The current fiscal situation of various countries is nothing short of a high-energy thriller. The U.S. national debt has soared to $35 trillion, with interest payments exceeding $1 trillion annually, more than its military spending. Can you imagine a country spending more on interest than on tanks and missiles? Consider Japan, where debt accounts for 260% of GDP, and the central bank's balance sheet has grown to 1.3 times GDP. This isn't just easing, it's flooring the accelerator, practically smoldering. Europe isn't much better, with many countries' deficits consistently exceeding the EU's 3% ceiling. France's deficit is approaching 5%, while Italy's and Spain's are even higher. This scenario is like a credit card. The limit has long been maxed out, and you can't afford the minimum payment every month. So you have to use another card to make up for it. You can still procrastinate in the short term, but we both know this strategy will eventually fail. Many people have always believed that buying government bonds is a guaranteed win and the safest investment. But reality has slapped them in the face. Why? Because inflation is coming. For example, the interest rate on a 10-year U.S. Treasury bond is currently 4.8%, which sounds great. However, don't forget that core inflation is still at 3.5%. After doing the math, it's clear that the real interest rate is barely positive. Europe and the UK are in an even worse position, with negative real interest rates. What does this mean? You thought you had the safest asset, but you found that it's safe, yes, but your money is slowly shrinking. You haven't lost money on paper, but your purchasing power is declining day by day. It's like saving $100, only to find that a year later, you can only buy something that originally cost $90. That's the heartbreaking part. So, are government bonds truly a safe haven or a chronic loss trap? For the past decade or so, central banks around the world have dominated the bond market. The Federal Reserve, the European Central Bank, and the Bank of Japan have been relentless buyers, using quantitative easing (QE) to push interest rates down aggressively. The market has grown accustomed to these unrivaled buyers supporting it. But now, a dramatic reversal. In an effort to curb inflation, these central banks have stopped buying bonds and have begun shrinking their balance sheets (QD), which has resulted in them directly dumping bonds into the market. The result is that the biggest buyers have suddenly withdrawn, leaving the bond market empty. Supply and demand have completely lost balance, so naturally prices can no longer hold up, causing interest rates to soar. In short, the central bank has transitioned from being the strongest market supporter to an indifferent bystander. It previously had financial backers protecting it, but now it must shoulder the brunt of the impact alone. Just imagine how devastating this is. In the past, major players like pension and insurance funds were die-hard fans of government bonds. No matter how the market fluctuated, government bonds were their standard. They were bought blindly and held for the long term, as unwavering as faith. But now, the situation has completely changed. They've started demanding higher term premiums. The message is clear. If interest rates aren't favorable, they won't commit to a long-term position. In other words, you want me to hold my money for 10 years? Okay, but you have to offer me a better yield. Otherwise, sorry, but I'll take my chances. This bond market crisis is not an isolated incident. It is triggering 4 major chain reactions around the world. 1. Global financing costs are rising across the board. 2. Emerging markets are experiencing a double whammy of capital outflows and currency devaluations. Stock and bond losses have become the new normal in developed countries. Central banks face the dilemma of saving the bond market or controlling inflation. This is called monetary policy failure, and neither option is effective. In short, we are witnessing a major global capital reset. The storm in the bond market is far from over. This marks the end of the 40-year bond bull market and the end of the era of low interest rates, high leverage, and central bank guarantees. The future will bring 1. A new environment of higher interest rates and greater volatility. 2. Governments, businesses, and individuals will be forced to deleverage. 3. An era in which real assets, gold, silver, resources, and energy will be increasingly favored. Whether you'll be swept away or rise with the tide in this new cycle depends on who you are, what assets you hold, and how you position them. This isn't just a problem for one country. It's a systemic collapse. U.S. 10-year Treasury yields broke through 4.8%, and 30-year yields approached 5%, reaching their highest level since 2007. UK 10-year Treasury yields soared to 4.7%, and 30-year yields exceeded 5.6%, breaking records since 1998. Germany 10-year Treasury yields reached 3.2%, the highest level since the 2011 Eurozone crisis. Japan 10-year Treasury yield surpassed 1.1%, breaking the Bank of Japan's long-standing yield curve control (YCC) policy ceiling. Even more bizarre is this. The Federal Reserve, the European Central Bank, and the Bank of England are all sending dovish signals and repeatedly hinting at an impending rate cut. Yet, long-term bonds continue to plummet instead of rising. Where did the massive outflow of funds from the bond market go? The answer is clear. Gold and silver. 1. Gold prices soared by over 20% in a single month, surpassing $3,500. 2. Silver prices rose an impressive 15% in a single week, surpassing $40. 3. Holdings in the world's largest gold ETF, the SPDR Gold Trust, GLD, increased by over 100 tons in 1 month. Inflows to the silver ETF iShares Silver Trust, SLV, reached a 2021 high. The market had originally predicted that these prices might not be reached for another 5 to 10 years. They actually saw their entire gain in just a few weeks. The phenomenon is clear. The bond market is collapsing while the prices of gold and silver are soaring. Now let's discuss the weirdest part. Why are central banks around the world cutting interest rates when the bond market is collapsing even more? This completely defies conventional financial wisdom. Textbooks clearly state, interest rate cuts lower capital costs, higher bond prices, lower yields. But now everything has been reversed. The central bank argues that the economy is under significant downward pressure and that interest rate cuts are necessary to stimulate recovery. However, the market's logic is that cutting interest rates at this time proves that the economy is worse than it appears. It suggests that government deficits are about to explode, debt is unsustainable, and inflation may recur. As a result, people are not only refusing to buy, they're also frantically selling long-term government bonds. To put it bluntly, the central bank tried to appease the market, but the market had already seen through its weakness and acted accordingly. This is also because the central bank's credibility has completely collapsed. Central banks used to be the market's stabilizing force, its almighty God. Now, their influence is rapidly slipping. 1. The Federal Reserve repeatedly stated that inflation is temporary in 2021, but was forced to implement an emergency 500 basis point rate hike in 2022. 2. The European Central Bank went from vowing no rush to raise rates in early 2023 to implementing a series of significant rate hikes in the second half of the year. 3. The Bank of Japan stuck with its YCC policy until market shocks made it unsustainable, ultimately forcing the bank to abandon it. If the central bank says, "Trust me," the market will only sneer and ask, "What about last time? You said the same thing last time." What happened then? Once trust is gone, all policies will be interpreted the opposite way. Interest rate cuts will be seen as a sign that the economy can't sustain itself, and monetary easing will be seen as a prelude to collapse. Everyone's mindset has completely changed. The bond vigilantes have reappeared. For the past decade or so, people blindly trusted the central bank, buying bonds when monetary policy was loose and selling them when it was tight. That strategy no longer works. The old-school concept of bond vigilantes is making a comeback. It refers to the market punishing fiscally irresponsible governments with sell-offs, issuing bonds and spending money recklessly. Then I'll make borrowing costs unbearable. This isn't emotional trading. It's a manifestation of market discipline. The result is a bond market crash and a massive influx of funds into hard assets, such as gold and silver. Given these forces, the conclusion is clear. The bond market is failing rapidly, and investors have nowhere else to turn except to gold and silver. Why is everyone finally clamoring for gold and silver? First, people are realizing that these are the ultimate safe haven assets. Once a government's credibility is questioned, fancy assets become unreliable. The market recognizes only the true currency that has remained unshaken for thousands of years: gold and silver. Second, real interest rates remain negative. Although nominal interest rates appear to be falling, inflation remains stubbornly low. As a result, holding gold, which has virtually no cost, has become the most cost-effective option. Third is the issue of hype versus hard evidence. While the US stock market is riding the wave of AI hype, the rise in gold and silver is driven by hard facts: the debt crisis, distrust of central banks, and rising inflation, ironclad, unstoppable realities. Therefore, the surge in gold and silver prices is no fluke. In this chaotic era, it's the most rational and almost inevitable choice for investors. So, what should ordinary people do? Here are a few practical strategies. 1. Bond. Shorten the duration and avoid long-term bonds. For example, 20 and 30-year Treasury bonds are highly volatile. Prioritize short to medium-term bonds with maturities of 2 to 5 years, such as U.S. Treasury Bond ETF, SHI, 1 to 3 years, and IEI, 3 to 7 years. 2. U.S. stocks. Shift to defensive sectors now. 1. Utilities XLU, healthcare XLV, and consumer staples XLP. 2. These sectors offer stable cash flows, pricing power, and dividend payouts, even in a downturn. 3. Directly invest in gold and silver. 1. Gold ETF, GLD and IAU. 2. Silver ETF, SLV. 3. Mining companies Newmont, NEM, and Barrick Gold, volatile but more resilient in market conditions. 4. Strategic resource stocks, copper, rare earth, uranium. 1. Demand for these resources will only increase with the global energy transition and the AI revolution. 2. Stocks to watch: Freeport-McMoRan, FCX, copper, MP Materials, MP, rare earths, and Cameco, CCJ, uranium. 5. Traditional energy, oil, and oilfield services companies. 1. Crude oil cannot be replaced in the short term. Geopolitical conflicts and a tight supply-demand balance mean that oil prices are likely to rise, not fall. 2. Target stocks: ExxonMobil, XOM, Chevron, CVX, and Schlumberger SLB. Finally, I'd like to pose an open question. Is this gold and silver boom just the beginning? When central banks lose credibility, government debt spirals out of control, and the market becomes the judge, what happens? Are we witnessing the twilight of the old financial order and the dawn of a new cycle for hard assets? Where will money flow over the next decade? Are gold and silver just the beginning or the prelude to a larger trend? Feel free to share your thoughts in the comment section. You can also mention which asset classes you're currently focusing on. I'll provide a more targeted analysis later. Alright, that's it for today's video. If you found this helpful, don't forget to give it a thumbs up. It really helps the channel. And of course, make sure to subscribe and turn on the notification bell so you won't miss my upcoming insights on the markets and investment strategies. I'd also love to hear your thoughts. Where do you think the market is headed next? Share your ideas in the comments. Let's learn and grow together. Thanks so much for watching, and I'll see you in the next one.